welcome out to your Maverick trading room as we prepare for the week ahead, November 11th through the 15th. Corey here with you, and I'm excited to go through it. We've got a lot of ground to cover. Of course, we've passed the presidential elections, the Fed meeting, plenty to talk about. Let's jump in. So as we do that, we're going to talk about major news in the markets, and obviously there is plenty of that. We're going to talk about how the markets behaved this week, which was quite predictable, kind of a volatility crush. And then as always, we're going to look at last week's trades, upcoming trades, opportunities, our best ideas, and we'll do it together.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, so as we prepare for the week ahead, we've got to talk about how last week went, and I love this saying by Joe. We talk about it often. Such a great picture of Joe too. I don't care whether I'm right, I just want to make money. And what a great motto for Maverick as we talk about the presidential elections, right? In the presidential elections, there's a lot of, oh, I was right, or you were wrong, or finger pointing and so forth. And in the markets, you know, whether your candidate won or not, we want to trade the market in front of us. We don't want to get caught up in those emotional need to be right or need to have our candidate this or that. And, you know, we want to just be on the side of making money. So with that, you know, we talk about what happened last week, and I'm sure you're sick of it. I'm sort of sick of it myself here, but we got to talk about the presidential elections. And what happened this week is something that is commonplace. And this week's event was what we call a known unknown. Now, there are such a thing as unknown unknowns, but this week was not that, right? So let's do a comparison. What is an unknown unknown versus a known unknown? This week we had the date, the time, the everything for when the presidential election was going to take place. It happens on Tuesday, November 5th, you know, and we expect to have the results by such and such a time. In other words, we know a lot about this. And so the market has time and has an opportunity to adjust. And people can say, well, what if we don't get the results right away? What if there's riots? What if there's allegations of wrongdoing? But the point is that it's known. We know it's coming. We know the date, the time. There's preparation that can be had. So if somebody wants to buy volatility, wants to protect their portfolio, whatever, there's so much known that all of these scenarios can be priced in. There is an unknown component to it, which is, well, who's going to win and what does that mean for policy and so on. So there's still some volatility, but when it's a known unknown, this is like earnings. There's often not as much of a reaction as people think there might be. Usually this leads to what we call a volatility crush, where there's angst and anticipation and nervousness as you go into this event, but then the unknown becomes known and everyone kind of looks around and goes, well, we got the answers, so now it's business as usual, right? And so this anxiety, this volatility gets overpriced, and then usually it gets crushed. And you saw that this week. The VIX absolutely imploded. Now, an unknown unknown is different. An unknown unknown comes out of nowhere. It is not scheduled. It is not planned for. There is not a date and a time of it. And then you have all the unknown of, well, what does this mean for the economy? What does this mean for the Fed? What does this mean for policy? Whatever, right? So unknown unknowns are unscheduled, and they could be good or bad. I mean, if you were looking at them, the creation of the internet, that's an unknown unknown. The creation of AI, you can argue whether that's good or bad, but ultimately that's an unknown unknown, right? It's not scheduled. Different discoveries that they make for drugs, natural disasters, terrorist activities. All of these things are unknown unknowns, and those usually lead to volatility surges because there's so much uncertainty. And so if you're asking, well, is there usually follow through? If it's an unknown, usually there's a lot of follow through. COVID was an unknown, and you saw the markets absolutely implode. And for weeks, the market sold off because it had to price in all of these uncertainties and negativities for the economy and for corporations and so on. And it literally came out of nowhere. Nobody could be prepared for it. So, in terms of this event, it's always important to kind of understand that the presidential election was a known unknown. You'll typically get that volatility crush. Of course, there could have been something that came out of nowhere from it, but for the most part, people already had anticipated so many possibilities and scenarios, and certainly, there was clarity. The Fed cut rates. That was another, question mark, but markets were expecting a 25 basis point cut. They cut by 25 basis points, but it's more about their commentary. And Powell says, look, our policies, where rates are, they're still restrictive. The consumer is not able to borrow. The corporations, these rates are too high, and so on. So you have kind of this battle going on because the market has actually pushed rates higher since the first Fed cut, but the Fed is cutting rates. And who wins? Well, the Fed is thinking that they can get the market to follow suit. They're thinking that they can influence market interest rates lower. But we see, mortgage rates up above 7% and so on. When he says it's restrictive, he's saying it will slow the economy, it will slow down growth, and we don't need that right now. We've got inflation under control, so they think rates are too high, and it's basically a little signal that there's more cuts coming. Elections bring optimism. There's worries about what Trump might do with tariffs. Massive amounts of tariffs around the world are not necessarily seen as a positive. I wouldn't see them that way. If you go back and study the Great Depression, a lot of that seemed to have come from tariffs and actually some of the things that happened there. So global trade is a good thing. Now, obviously, if certain countries are taking advantage of others and not playing fair and so on, then tariffs create more equality in that. So you could argue that China for many years has certainly not been completely fair in some of the things that they've done. So people cheer on those tariffs, but I would personally not like to see massive amounts of tariffs around the world. I don't want to see huge tariffs being dropped on Europe and all these other countries, because the reality is that the US has had many advantages for many years, and certainly with our allies and trading partners and so on, we've got to be careful about that. But markets seem to be pricing in that Trump will go the pro-growth and slow and calm on his tariffs. They're saying Trump always looked at the stock market as a barometer. He always wanted the stock market to be going higher. He was pushing pro-growth policies on his last period as president, and they think that that's going to be where they follow suit. And I would tend to agree. He certainly, I think, would be more inclined to do things. He argued about the Fed and that they should be cutting rates and all these things back when he was president. So I think that's where he stands, is he's going to try to drive enormous amount of growth and show a strong stock market and all those things during his presidency here. So as we look in the rearview mirror, obviously we had the presidential elections. Now we've got a president-elect. We've got some certainty there. We got the Fed funds rate down a quarter point. Those were the unknowns, and they became known this week. And as that uncertainty grew to certainty, you saw the markets explode. So where were we at? Well, markets for the week, all of these markets up around 5%, with the Russell up almost 9%. Oil slightly higher, gold slightly lower, but it was a strong, strong week. Make no mistake. So the markets were right here, right on top of the 50-period moving average. It could kind of go either way here. And what did it do? Well, it picked a direction, right? It went up, volatility imploded, and we continued the trend. The S&P broke out to new all-time highs. The NASDAQ followed suit, new all-time highs. And look, we're in a bull market. This is if you're looking at the NASDAQ, this is a pretty good base here. that it's built underneath, that it's now breaking out from. So I would anticipate that there's some more room to go. Now, my word of caution would be that eventually, in the maybe the not too distant future, we're going to start to see signs of exhaustion. Basically, signs that this market is overheating. But I think it's a little premature, certainly a little too early to be calling for massive exhaustions and things of that sort. Right now, this looks like a nice foundation that you can continue to build off of. So I see no real reason to be mega cautious right here, right now. We'll just try to trade with the trend. And as you look at the weekly results, I mean, it's just widespread. Tesla up 29%, certainly with Elon Musk as President Trump's right-hand man. You'd expect his corporation to seemingly be a beneficiary of these things. Nvidia up 9, the financials up big. I mean, it was widespread. Certainly a little bit more red in healthcare. The expectation is that with RFK Jr., if you're going to go after healthcare companies, if you're going to go after consumer names like Coca-Cola and some of these things, that's where the concern comes in. How aggressive are they going to go after the consumer brands trying to create healthier products and so forth? How far are they going to go on vaccines? Those seem to be some areas of uncertainty, and you certainly saw that this week. The trend is still up in markets, certainly breaking out of some bases. More money came pouring back into stocks. I think it was maybe nervousness pre-elections, worried about how bad things could get and what type of turmoil there could be around the elections, and then simply came pouring right back in. And certainly an expectation that Trump is going to try to push the economic growth strongly higher. CPI comes out on Wednesday, and that's one to watch where obviously inflation has come down significantly, but you can't really put the genie in the bottle. We went through a period of just enormous inflation, and we don't want to have a repeat of that. That was particularly bad for the lower end consumer, where they just people that basically don't own a lot of assets but still have to pay those higher prices. So it's just one of those things where if we continue to have that, it becomes a bigger and bigger problem. But right now, inflation seems to be calm, 0.2%. We don't want to see any big spikes on that. And then Fed Chair Powell will speak again on Thursday. Now, if you look at this schedule for the week ahead, nothing too major as compared to this past week. So right now we probably enter into that phase where you can just kind of take a little bit of a deep breath. There's always the possibility that something comes out of nowhere, but for now, I think it's kind of status quo, hopefully into year end. So as we look at the markets, we've based here for a few weeks really, and started to break out to the upside again. The moving average is still a little bit sideways, but starting to curve back up. So certainly starting to get that bullish tint back to it. Now, if we look at sectors, widespread buying. I mean, some of these numbers are just out of this world. I mean, fantastic as we look at them. Energy up 6.5%, and tech up 6%, and consumer up 7.5%. Financials, industrials. I mean, it's a good year for the stock market if it makes an 8 to 10% return. Some of these sectors were doing that in 1 week's time. There were the laggards, of course, but overall, just a robust upside move. Now, if we break them down individually, we've got utilities still sort of lagging. We're below the 20, below the 50. Those moving averages are sideways, so we can't really call this a runaway downtrend by any stretch, but it's a little bit more negative. You're starting to see the 20 roll over. If we stay down here in these 70s, that 20 is going to come down and cross the 50. It's just the inner workings of a possible new downtrend developing. So utilities, you got to be a little bit more neutral to maybe mildly bearish on that sector. Communication services continue to stay strong. This is lower left to upper right. little pullback, but think about where this sector was and how it compared to the S&P. The S&P pulled all the way back to its 50 period moving average. Communication services, a little dip, not even back to the 20, and then right back up. We had a trade on in this sector, actually T-Mobile. I did the trading room a few weeks ago, and T-Mobile was one of those trades, and it finished perfectly. We bought I think it was like a 125, 135 call spread with today's expiration. It finished right above 135, just picture perfect. So this sector continues to treat well. Real estate, you look at this chart and what do you make of it? Crisscrossing moving averages, sideways moving averages, just above the 20, but just below the 50. It's sort of, I could go neutral. I mean, if you wanted to say this is a 0, I could go for that. The reason I'm going to give it just a slight -1 is we did have the 20 cross below the 50. So this is not something that is just transpiring. This thing's actually been trending lower for over a month now. It's not a big downtrend, but it's a little downtrend. So I'm just giving it basically that very slight negative look. Again, kind of neutral to very mildly bearish is how I would see it. Healthcare, a little bit worse. Again, it's been trending lower for well over a month. 20 crossed the 50, and again, we're just lower highs, lower lows. We did get just barely above the 20 this week, but I'm not so sure I trust it. Still a sector that if you're looking for bearish trades, you're probably looking within healthcare for some of those candidates. Industrials, this looks solid. Now, maybe not quite as good as some others in that it pulled all the way back to the 50, right? Kind of similar to the S&P 500, but still broke out to the upside. So I kind of went between a +2 and a +3. I just said, well, you're still kind of sloping up. You're above all those. We'll go ahead and give it the benefit of the doubt and a +3. Financials, same thing. A little bit of a pullback here, but still lower left to upper right, trending higher for multiple weeks. Just strong. Probably, as good as most sectors out there. So financials still on a +3. Yeah, consumer stocks, again, didn't pull back as far, so even more relative strength. You can see a basing pattern here that had been intact for multiple weeks. It just broke out of. This sector looks really good to my eye, +3, and we've got a candidate for more upside within that sector as a trade idea this week. Technology, I can kind of go either way on this one in terms of I didn't give it quite as good of a bullish reading. I didn't like that it pierced the 50. Now that seems to have been kind of a false move lower. The moving averages are still just a bit more sideways. And yeah, we've cleared resistance slightly, but it just doesn't look quite as good, quite as strong as some of those others. So I've got it in, and I could go +1 to +2-ish. I gave it a little bit more of a downgrade, kind of deciding between the two, a little bit worse, I guess. I wanted to make that clear that I didn't like this sector quite as much as some of these others. Materials, this is about as good a 0 as you can get. Right in between the moving averages, kind of this wedging type of formation, lower highs but higher lows, and just funneling sideways. It's a nothing burger there. And then energy, it kind of had that false downside move and then the break higher. Again, I looked at this sort of like tech. Do I really give it the benefit of the doubt? You still have kind of that sideways slope. I think it's clearly more bullish than anything, but it's kind of a +1, +2-ish, and went with the +1. Just wanted to differentiate that these don't seem, energy and tech just don't seem quite as strong as these other four. So a little bit more of a dividing line. And if you wanted to say, well, I think energy and tech should be in the +2-ish, I could go for that. I mean, it's probably one of those things where it's in the eye of the beholder a little bit, in that, have they broken out above prior highs and so forth. In the case of tech, it did. In the case of energy, it's right into resistance. So I would prefer if you were going to push one over, I'd go tech right here and then keep energy in that +1. But I could go either way on that. Real estate and utilities, more negative. Healthcare, the worst of the sectors. All right, so let's come into our trade slots. We're losing a few. We're losing an industrial. We're losing a financial. I already mentioned we're losing T-Mobile, that communication services. So a few gone. We've got some new additions coming in that we'll talk about. And given our market score, we've got to add some bulls. And our market score was +2. Again, it was sort of, we broke out to new highs. We had this deeper dip and these moving averages kind of flat and sideways for a few weeks, just starting to break out. So +2, +3-ish, certainly more bullish. In the +2 for now. I think another solid week, and you've got to probably upgrade it even further. But for now, I'm going in the +2 category. So we're looking to fill up these trade slots. Now, I've got 4 new trades, and we want to get more of the bullish side. So you'll notice I'm adding 2 in the +2 column, 1 in the +1, and 1 in the neutral, which will take our numbers up. Now we'll have 2 here, we'll have 2 here, we'll have 2 here, we'll have nothing in that, we'll have 2 here, and we'll have 1 there. And so all of a sudden we're getting more of that pattern and that possibility of what we want, basically, which is to mirror the market and have a little bit more bullish outlook than anything else. So with that, I'm going to start in the industrial sector. Here's CSX. Now, this stock has been in a basing pattern for quite some time, and it has kind of a weird pattern here where you basically gap down to this level and then gapped up away from it. And this is called an island reversal. Basically, you have left this price action down here on an island, and normally we'll kind of leave this gap open and unfilled. So the expectation is that CSX is probably not going to go massively higher, but kind of continue to work its way up. And it's a pretty straightforward, just buy the 36 call, sell the 37 call, and you're just targeting it to be above 37 in a couple of weeks' time. That risk to reward, this is a bull call spread, and the way this breaks down, if you were to look at it and profit and loss, this trade comes out to about a 40-cent debit. Now, I'd love if you could pay less than that, 38 cents or something, but even at that number, you've got 60 cents of reward and 40 cents of risk. You've got a trade that for $60 of upside, your max loss is 40, and your break even's right in here. You've got a trade that basically looks like this, where if it's below 36, you lose $40 per spread. If it's above 37, you make $60 per spread. So as long as we finish above here in a couple of weeks, we are golden, my friends, and that's how I anticipate this to go. So we've got that island reversal trade. We think we leave this price action here on an island and just work our way higher. Next, we've got financials. And again, within financials, this was a very bullish sector. Here we're looking at for a +1 trade. So I want something that's bullish, but maybe, I don't need it to be mega bullish. And with Berkshire Hathaway, the symbol is BRK space B. So you have to put a space in between the K and the B on Interactive Brokers platform. All I'm looking for here is, again, a 2-week trade, a bull call spread, buy the 460, sell the 465. That is not a big risk to reward trade. I'm going to give you, just like in the other one, I think you can get better numbers than this, but this has about $3 of debit or $3 of risk for $2 of reward, roughly. But the probability of success here, I think, is much higher than the prior trade. And the expectation is that we stay above this gap area, and I think that's a very good probability. So Berkshire checks the box on a lot of different things. Number one, I think we're going to work our way back up here to higher prices. And all we need to do is just be above these levels, and we're going to be at max gain. That's just not a high hurdle at all. Number two, I think when you look at this company, it checks the boxes for what a lot of investors would be looking for to play to the upside. One, it's a financial. Two, it's dependent on strong economic circumstances because they're high in the consumer space, and the consumer sector was very bullish and one of the best sectors as well. So it's kind of a financial consumer stock hybrid. It really should be in the best sectors and the best areas for the market over the next couple of weeks. So pretty straightforward, not high risk, low reward. And I'd say the same thing about this. I think you can get better than a $3 debit. So if you can pay 290, 280, 270, you want to pay less. Just like I think in the prior trade, you could probably pay a little bit less than 40-cent debit. But those are kind of the numbers where we're at right here. So Berkshire, as long as we finish above 465 in 2 weeks, we have maximum profit. Consumer stocks. I mentioned that this was maybe my favorite sector, and Amazon is in that sector. This is just your classic bullish breakout. Amazon is ripping to the upside. Here we're going a little more aggressive, buying the 210, selling the 220 bull call spread. I need Amazon to go up more. Out of all of them, this one maybe needs to stretch the most, but I think that's a very real possibility. In this case, we're going out 3 weeks time. So we're giving ourselves 3 weeks until November 29th. The others were November 22nd expiration. This one has 3-week expiry. So we're giving it a little bit more time to reach that higher hurdle. Again, excellent risk to reward, over 2 to 1 reward to risk ratio. It's closer to 3 to 1 actually reward to risk ratio on that structure. So just your typical bull call debit spread. Last but not least, we've got the materials, which we've got as a 0. You can't see it on this chart, but Newmont Mining has a 200 period moving average right down here. And you can see the 50 and the 20 coming down here. And the expectation is that this will create a wedging effect. That basically you're going to languish down here kind of against that 200-day moving average for a while. And so the trade is, again, 2-week expiration, November 22nd, buying the 50, selling the 45, buying the 40, and it can be put or call. I prefer using the put butterfly because that will avoid any possibility for early exercise based on dividends and such. But if you buy the 50, 45, 40 put butterfly, you're buying the 50 put at a ratio of 1. You're selling the 45 puts at a ratio of 2. And you're buying the 40 put at a ratio of 1. So you're buying, you're selling twice as many, and you're buying. That's how a butterfly works. Now, the breakdown on this trade, if we look at the risk graph, you got your profit, you got your loss, you got your prices, and basically 40, 45, 50, the way that this structure works is that it's going to be very nice and very profitable the closer you are in 2 weeks to that $45 price right here. And I think that 45 becomes a sticky area. Now, will it move away from there temporarily? Of course, the stock's not just going to flatline. It's going to bounce up, it's going to bounce down, but it should keep working its way back into that middle area. And that's what we want, is basically screw around for a while, but stay sticky to this general price range. It's an excellent risk to reward, again, because it's considered to be a lower probability trade. So these butterflies are not supposed to land often, but they're supposed to have a higher payout. And you want to be very selective with butterflies because they are a lower probability of success strategy overall. Now, In conclusion, the trend is up. Sometimes you just want to go with the flow. If you look below the surface, the market has based for multiple weeks and has started to break out. Generally speaking, those have a few more weeks to go before you start to really trigger some exhaustion signals and some things to really be worried about. So we're going to give the market the benefit of the doubt right here, right now. Continue to look at sector analysis, try to trade the stronger sectors, the stronger areas of the market to the upside, and the weaker things to the downside. As the old saying goes, there's always a bull market and a bear market somewhere, and that's what we want to trade. We want to trade the bullish market areas and sectors to the upside and play the bearish ones to the downside, and that's playing relative strength, relative weakness, which is a very good idea long term. Hope you enjoyed today's trading room. Have a great weekend, everyone, and a great week ahead. We'll see you next time. Goodbye.